Okay, let's just dive right in. The news literally just hit, and if you were kind of banking on interest rate cuts this summer, you might need to take a breath.
Yeah, that's putting it mildly.
That latest U.S. jobs report just out, June 7th, 2025.
Mm.
It was a bit of a shocker, stronger than pretty much everyone thought it would be.
Mm-hmm.
And one expert we looked at was blunt, called the report the nail in the coffin for any hope of summer rate cuts from the Fed.
Right, because it's not showing weakness, it's showing, well, the phrase used was strength with staying power in the job market.
Exactly. And look, this isn't just, abstract economic numbers. This stuff directly hits your finances. It touches everything, the rate you might get on a house or a personal loan, even how much interest your savings are actually making or not making.
Absolutely, it connects directly. So, welcome to the deep dive. We've waded through a whole pile of recent financial articles, expert takes, market data, all zooming in on one main question. What is the Federal Reserve up to? Especially with their latest moves. And maybe even more critical, what does it actually mean for your mortgage, your loans, your savings account right now?
Yeah.
Our goal today, cut through the jargon, pull out the really important stuff from all this material, and help you figure out the so what for your own financial life.
And that's so important because the Fed's decisions, they really do ripple out and affect all of us. At the core, you've got the Federal Reserve itself. It's the U.S. central bank.
Right.
Its job, fundamentally, is to try and create the conditions for a healthy economy. That means overseeing banks, managing the money supply, and crucially, setting monetary policy, which includes, steering interest rates.
And the big one we always hear about, the rate the Fed actually sets, is the federal funds rate. Can you just quickly remind us what that is and how it links to the rates, we actually see? Sure. So the federal funds rate isn't the rate you pay on your car loan or credit card, not directly. It's the target rate banks charge each other for borrowing money overnight. They need to meet certain reserve levels.
Okay, bank-to-bank stuff.
Exactly. But that rate, that's the Fed's main lever. It's how they influence borrowing costs across the whole system. When they raise that rate, it gets more expensive for banks to borrow short term. And that cost eventually gets passed on. It leads to higher rates for consumers, for businesses, on all sorts of loans. And the reverse is true to lower the rate. And the idea is to make borrowing cheaper, get the economy moving.
Got it. So that's their key tool. Given that, what happened at their last meeting? What was the decision?
Okay, so the FOMC, that's the Federal Open Market Committee, the group that actually makes these rate decisions, they met back on May 6th and 7th, just last month, 2025.
Right.
And the headline decision was, hold steady. They voted to keep the target range for the federal funds rate exactly where it was.
Which is?
4.25% to 4.50%.
And this wasn't the first pause this year, was it?
No, good point. That May decision made it the third meeting in a row in 2025 where they just held the rate, maintained it at that level.
Okay.
And remember, this came after a period at the end of 2024 where the Fed actually cut rates 3 times in a row. They were moving away from the earlier hikes then.
Right. Those cuts were pretty significant at the time.
They were. So after those cuts, 2025 has basically been, well, a pause. Stability, you could say, in their main rate. Some of the sources called it a wait-and-see approach.
Wait and see. Okay, so what are they waiting to see? What kind of data are they watching to figure out the next move?
Well, according to everything we read, they're really zeroed in on the incoming economic data across a few key areas, like the labor market, definitely watching that closely, job numbers, unemployment, wages, how much people are earning.
All right.
They're also looking very hard at inflation. Are prices still going up too fast? And maybe just as important, do people think prices will keep rising? Those expectations matter.
Inflation expectations, right?
Exactly. And then they consider, the broader picture, what's happening in the U.S. economy overall and internationally, too. It all feeds in. Don't forget, the Fed has this dual mandate from Congress.
Maximum employment and stable prices.
You got it. Keep unemployment low, keep inflation low and stable. And right now, they're trying to walk this tightrope. Parts of the economy look strong, like that jobs report, but inflation, it hasn't fully gone back into its box yet.
So it's a balancing act.
A very tricky balancing act, and that means watching the data like a hawk.
Okay, so Fed paused in May, continuing this 2025 holding pattern after those cuts last year. How does that decision and just the generally higher rate environment we're still in translate down to something huge like mortgage rates, if you're looking to buy a house right now?
Right, mortgages. This is where the link isn't always as straightforward as people think, especially for fixed-rate mortgages. Let's start there, since that's what most people get.
Okay, fixed rate. That's the one where the interest rate and the main part of your payment, the principal and interest, it just stays the same forever, right?
Right.
Or for the whole loan term.
Exactly. You lock it in 15, 20, 30 years, whatever the term is. Your rate doesn't change. The huge plus there. Predictability.
Makes budgeting easier.
Totally. Your main housing cost is stable. It protects you if market rates shoot way up later on. And, they're generally pretty simple to understand compared to other types.
The downside being, if rates plummet after you get your loan, you're kind of stuck with your higher rate.
That's the trade-off.
Yeah.
You don't automatically benefit from falling rates. You'd have to refinance, go through the whole process again, pay closing costs to get that lower rate.
Right. Costs involved.
And another point, in a higher rate world like we've seen recently, those initial payments on fixed rate loans can be pretty hefty, which might make it tougher to qualify compared to, say, an adjustable rate loan that starts out cheaper.
Okay, can we talk about that payment structure? Even though the payment is fixed, how it breaks down changes over time, right?
It does, and the sources had a good example using an amortization schedule. Let's say you borrow $100,000, fixed rate 6%. Your monthly payment for principal and interest comes out to like $599.55 in that very first payment. Most of it is interest. Like $500 of that almost $600 payment is just interest. Only about $100, maybe even less, $99.55 in the example, actually goes to paying down the loan balance.
Wow. So you barely make a dent at the start.
Barely. That's why it feels like you're paying forever initially. But, and here's the key, as you keep making those $599.55 payments month after month, the split shifts.
How so?
Gradually, a little bit more goes towards principal each month and a little bit less goes towards interest. By payment number 3 in that example, maybe $199.55 goes to principal, $499 to interest. Still mostly interest, but the principal portion is growing.
And the total payment stays the same.
Exactly, $599.55 every time. But the inside mechanics change. Fast forward way down the line, near the end of the loan, then the vast majority of your payment is going towards principal.
And the length of the loan, 15 years versus 30 years, that makes a massive difference in total interest, right?
Oh, huge difference. A 30-year fixed loan, it gives you the lowest possible monthly payment. That's crucial for affordability for many people.
Makes sense.
But you're paying interest for 30 long years. So the total amount of interest you pay over the life of that loan is way, way higher than with a shorter term.
Like a 15-year.
Yeah, take a 15-year fixed, your monthly payments will definitely be higher, no doubt about it. But you usually get a slightly lower interest rate to begin with, and because you pay it off twice as fast, the total interest you pay is dramatically less. We're talking potentially saving tens, maybe even hundreds of thousands of dollars in interest compared to the 30-year.
That's a staggering difference over time. Okay, so we get how fixed payments work. Now, the connection question. How does the Fed's move pausing rates in May actually influence these fixed mortgage rates? You said it's not direct.
Exactly. This trips people up all the time. Fixed mortgage rates do not move in lockstep with the federal funds rate. That's a short-term rate. Fixed mortgage rates mostly track the yield on the 10-year U.S. Treasury bond.
The 10-year Treasury. Okay, why that specific bond?
Well, think about it. Mortgages are long-term loans. The 10-year Treasury is kind of seen as a benchmark for longer-term expectations about the economy and interest rates. Lenders, and maybe more importantly, the investors who buy bundles of mortgages.
Mortgage-backed securities.
Right. Those investors compare the return they can get on those mortgage securities to the return on something relatively safe and long-term, like the 10-year Treasury. Mortgages need to offer a competitive yield.
So if the Treasury yield goes up, mortgage rates tend to follow to stay attractive.
Generally, yes. And when the 10-year yield falls, fixed mortgage rates usually drift lower too. It's the main benchmark they follow. But there's another piece. The sources mention the spread. That's the extra bit lenders or investors add on top of the 10-year Treasury yield to get the actual mortgage rate.
A margin? Sort of.
Kind of, yeah. Historically, that spread might have been, say, 1.5% to 2%. But lately, it's been wider, more like 3%, according to the source.
Well, it's wide.
Mostly because of increased market risk and uncertainty. Things feel a bit more volatile, so lenders and investors want a bigger cushion, a higher return for the risk they're taking on a 30-year loan.
That's really important. It means even if Treasury yields fall, mortgage rates might not fall as much as they used to because that spread is fat right now.
Exactly right. That spread matters a lot.
Right.
So the Fed's influence on these fixed rates, it's more indirect.
How so?
Well, the Fed doesn't set the 10-year Treasury yield, but their overall monetary policy, their announcements, their actions like buying or selling bonds, quantitative easing or tightening that stuff, definitely influences the bond market and the overall flow of credit.
Okay.
But other things matter too. big ones, like inflation expectations that heavily impacts bond yields, simple supply and demand for mortgages, and what's happening in that secondary market where mortgages get bought and sold. It's a mix of factors.
Got it. So fixed rates are complex, tied to the long end of the bond market, indirect Fed influence. What about the other main type, adjustable rate mortgages? ARMs. How are they different, and how does the Fed play in there?
ARMs are a whole different ballgame. Their key feature is that the interest rate is variable. It starts fixed for a set period, but after that, it can change, up or down, based on what broader market rates are doing.
And the appeal is usually a lower starting rate.
Almost always, yeah. The initial rate on an ARM is typically lower than what you'd get on a comparable fixed-rate loan at the same time.
Which sounds tempting.
It can be very tempting. Lower rate means a lower initial monthly payment. That might help you qualify for a bigger loan or just give you more breathing room in your budget for the first few years. And there's a potential upside. If market interest rates fall significantly after your fixed period ends, your ARM rate and your payment could actually go down at the next adjustment automatically without refinancing.
So in a falling rate environment, that could be good.
Potentially, yes. But, and it's a big but.
The risk is rates going up.
Absolutely. That's the major drawback, uncertainty. After that initial honeymoon period, your payment can jump around, makes budgeting harder. And if rates rise a lot, you could face some serious payment shock, big increases that could really strain your finances.
People certainly remember ARMs and rising payments from the lead up to the 2008 crisis.
Yes, the sources definitely nod to that history. Back then, ARMs were everywhere, sometimes with looser lending standards. When those rates started adjusting up, a lot of people just couldn't afford the higher payments. It was a big factor in the foreclosure crisis.
Have things changed since then?
Oh, yeah. There's much more regulatory oversight now. The types of ARM products available are often structured differently than some of the riskier ones from that era, but the fundamental risk of rising payments still exists.
So how does the adjustment actually work? How does the rate change?
Okay, there are a few key components. First is the initial fixed period. Could be 1 year, 3 years, 5 years. A 51 ARM is common, fixed for 5 years, 7 years, even 10 years. Usually, the shorter that initial fixed period, the lower the starting rate.
Makes sense.
After that fixed period is over, the rate then adjusts based on a regular adjustment frequency. Most commonly, that's once per year. That's the 1 in a 51 ARM. It adjusts every 1 year after the first 5.
Okay. And what decides the new rate each year?
It's usually calculated by taking a benchmark adjustment index and adding a fixed margin to it.
Index plus margin.
Right. The index is some published interest rate that reflects current market conditions, things like treasury bill rates, or maybe SOFR, the secured overnight financing rate. Those are common now. That index fluctuates.
Okay.
The margin is a fixed percentage. Maybe it's 2%, 2.5%, 3%. That's set in your loan agreement rate at the beginning. It doesn't change. So your new rate equals whatever the index is at the time of adjustment, plus your fixed margin.
Okay. So how does the Fed tie into this? Is the connection more direct here?
Yes, much more direct, typically. Many of those common ARM indexes, especially the ones tied to shorter-term rates like T-bills or SOFR, are very sensitive to the Fed's actions on the federal funds rate. If the Fed hikes the federal funds rate, those short-term indexes tend to go up pretty quickly. So at your next adjustment, your ARM is likely going up because the index part of the calculation went up.
And if the Fed cuts?
The index likely falls, and your rate could go down at the next adjustment. So yeah, if you have an ARM, what the Fed does in the coming months has a much more immediate potential impact on your payment than if you have a fixed rate.
That's a critical difference. Your payment could change pretty soon after a Fed move.
Depending on your adjustment schedule, yes.
Yeah.
Which is why understanding the details of your specific ARM is so vital. The sources mention things like caps.
Caps, like limits.
Exactly. Limits on how much the rate can change. Usually there are 3 main types. An initial cap limits the very first rate increase after the fixed period ends. A periodic cap limits how much the rate can go up or down at each later adjustment, say each year.
Right.
And a lifetime cap, sometimes called a ceiling, that's the absolute maximum rate your loan can ever reach, no matter how high the index goes. It protects you from truly unlimited increases. And the sources also warned about something called payment caps.
Payment caps. That sounds good, limiting the payment increase.
It sounds good, but it can hide a nasty risk. Negative amortization.
Negative amortization. Doesn't sound good at all.
It's generally not. Here's how it works. Let's say interest rates spike And based on the index plus margin, your interest rate should cause your payment to jump by $300. But you have a payment cap that only allows the payment to increase by $150.
Okay, so you only pay the $150 increase.
Right. But what happens to the other $150 of interest that was actually due based on your rate? It doesn't just disappear, it gets added onto your loan balance.
Whoa, so your loan amount goes up even though you're making payments.
Precisely. You end up owing more money than you did before. It's like you're borrowing the interest you couldn't afford to pay that month. Over time, you could owe significantly more than you originally borrowed. It's a really serious risk to understand if your ARM has payment caps.
Wow, okay, that's a sobering reality check on ARMs.
Yeah.
So given all these risks and complexities, when might an ARM actually be the right choice for someone?
It really comes down to specific situations and risk tolerance. Generally, an ARM might make sense if you are highly confident you'll sell the house or pay off the loan before that initial fixed rate period ends.
Like if you know you're moving in 4 years, you get a 51 ARM.
Exactly. You could potentially save money with the lower initial rate over those 4 years compared to a 30-year fixed. It could also make sense if you have a very certain significant income increase coming soon, like, you'll be able to handle much higher payments later.
Or maybe if you think rates are definitely going down.
That's the gamble some people take. If you take an ARM when rates are high, hoping they'll fall, you could benefit when it adjusts. But that's a bet. You have to be prepared for the possibility you're wrong and rates go up instead.
So it boils down to how long will you be there? What's your risk appetite? What's your outlook on rates? And can you handle the worst case scenario?
You nailed it. The sources really stress asking those tough questions. Calculate what your payment would be if the rate went all the way up to the lifetime cap. Could you afford that? If predictability is your absolute top priority, a fixed rate is usually the way to go.
And one final point on comparing mortgages fixed or ARM. What's the number one rate people should focus on when shopping around?
Always look at the APR, the annual percentage rate.
Not just the interest rate itself.
No, the interest rate is just part of the cost. The APR tries to capture the true cost of the loan because it bundles in the interest rate, plus many of the lender fees and other costs associated with getting the loan. Comparing APRs from different lenders gives you a much better apples-to-apples comparison of which loan is actually cheaper overall.
APR. Got it. Okay, that's a really thorough look at the mortgage landscape. Let's pivot now to personal loans. How do Fed decisions, like this recent pause, play out for personal loan rates?
Similar principle, really. The federal funds rate affects how much it costs banks and other lenders to get money. So when the Fed's rate is higher, the rates on products like personal loans tend to be higher too. When the Fed cuts, those rates tend to ease.
So with the Fed holding steady in May, what does that mean if I need a personal loan right now? Are rates just stuck?
Pretty much, yeah. In the immediate term, don't expect big changes. The May pause means personal loan rates will likely stay around their current levels, which, as the sources pointed out, are still near historic highs.
Even though the Fed cut rates late last year.
Right. Those cuts didn't seem to bring personal loan rates down dramatically, so this pause isn't likely to suddenly push them lower either. Stability, but at a high level, is the current picture for new loans.
Okay, but what if I already have a personal loan? Does my rate change?
This is key, and it's different from IRMs. The overwhelming majority of personal loans have fixed interest rates.
Yikes.
Which means if you took out a personal loan last year or even earlier this year and it has a fixed rate, your interest rate and your monthly payment are locked. They will not change no matter what the Fed does next.
That's a huge relief for people with existing loans. Certainty.
Absolutely. That fixed rate gives you budget certainty for the life of the loan.
So for someone needing a new loan now, with rates high, is the advice just to wait it out, hope rates fall?
Well, the experts seem a bit cautious on that. Yes, the general expectation is that personal loan rates should drift lower eventually, assuming the Fed does cut rates down the line, but it's likely to be slow.
And who gets the benefit first?
Usually borrowers with the best credit scores. They'll see the improved rates first. But one interesting point from the sources was that personal loan rates haven't always reacted super strongly or quickly to small Fed adjustments in the past. They aren't always as sensitive as, say, mortgage rates.
And they also kind of questioned whether waiting is really worth it for most people.
Exactly. The reality is, if you need a personal loan, you often need it for a specific reason now. Waiting months just hoping for a slightly lower rate might not be practical. And the actual dollar savings might not be enormous.
We had an example, right?
Yeah, something like a $5,000 loan on a 3-year term. A full 1 percentage point difference in the rate, say getting 9% instead of 10%, saves you less than $3 a month. Under $100 total over 3 years.
Not insignificant, but maybe not life-changing if you need the funds urgently.
Right. Might not be a game changer, as one source put it, compared to the need for the money.
Okay, so if waiting isn't the answer and rates are high, what can people do right now to try and snag the most affordable personal loan possible?
This comes back to controlling what you can control. Number 1, shop around. Seriously. Don't just take the first offer. Get quotes from banks, credit unions, online lenders. Rates can really vary.
Okay, what else?
Check your credit score. Know where you stand. If it's not great, take steps to improve it, paying bills on time, reducing debt balances. A better score means better rates.
Makes sense.
Also, pre-qualify with several lenders. This usually involves a soft credit check, which doesn't hurt your score, and it gives you realistic weight estimates before you formally apply.
Good tip.
And think about the loan itself. Can you borrow less? Can you handle a shorter repayment term? Shorter terms often have lower interest rates because the lender gets their money back faster, less risk for them.
Right.
Finally, if it's possible, applying with a creditworthy cosigner or co-borrower might help you qualify for a better rate than you could on your own.
Those are all really practical steps. And looking ahead, if rates do eventually drop significantly,
Then refinancing becomes an option. If you took out a personal loan when rates were high and they fall quite a bit later, you could look into refinancing that loan to lock in a lower rate.
okay, so we've hit borrowing, mortgages, personal loans. Let's flip the coin, saving money. How do Fed rate decisions hit our savings accounts?
This is probably the most direct connection we've talked about. The federal funds rate really does strongly influence the rates banks offer on savings accounts, money market accounts, and CDs.
How so?
When the Fed raises its rate, banks generally earn more on their own reserves, and they also need to compete for deposits, so they tend to pass some of that higher rate environment onto savers by offering higher yields.
And when the Fed cuts,
The opposite happens. Banks have less incentive or ability to pay high rates, so deposit yields tend to fall.
so the May pause. What does that mean for savings rates right now? Are they just stuck in place?
Not perfectly stuck, but don't expect big jumps. The pause suggests rates should be relatively stable for the moment. However, the sources did point out that after those 3 Fed cuts late last year, average savings rates have been slowly ticking down over the past few months.
So there's a lag maybe.
Yeah, some lag, and banks adjusting to the overall environment. So even with the Fed pause now, it's possible we could see some minor additional downward drift in savings yields. Just small adjustments, probably.
But despite those little dips, the message about high-yield savings accounts, HYSAs, still seems really strong. Are they still way better than traditional banks?
Oh, absolutely. This was a huge emphasis in the material. Even if the absolute peak rates have softened slightly, the rates available on good HYSAs are still dramatically higher than what you get at most big traditional banks.
What's the average at traditional banks? Still tiny?
Yeah, the FDIC national average savings rate cited was still really low, something like 0.42% APY recently. Just abysmal.
Wow, so where do you find these much better HYSA rates?
Primarily online. Online-only banks, or the online arms of bigger banks. They just have much lower overhead, cost no big branch networks to maintain, so they can afford to pass more back to savers through higher interest rates. It's how they compete for deposits.
And these HYSA rates, they can change, right? They're not fixed.
Correct. Unlike a CD, the rate on an HYSA is variable. The bank can change it anytime. But the key point is, even though they fluctuate, they consistently stay much, much higher than traditional savings account rates.
Can you give us that stark example again? The difference it makes?
Yeah, it really hits home. Take $10,000. If you park it in an old school savings account earning, say, 0.01% APY, you'll earn about $1 in interest over a whole year.
$1.
Okay. Now, put that same $10,000 in an HYSA earning a competitive rate, let's say 4% APY. In 1 year, you'd earn around $400 in interest.
Wow. $1 versus $400.
It's huge. And that $400 gets added to your balance and starts earning interest itself. That's compounding working for you, which barely happens at 0.01%. It makes a real tangible difference.
No kidding. Were there specific examples of good rates available recently?
Yeah, the sources listed several from around May 2025. Things like Forbright Bank at 4.25%, Axos at 4.66%, Varo had one at 5.000%, but sometimes those have hoops to jump through.
Okay.
E-Trade Premium Savings at 4.00%, Wealthfront Cash Account 4.00%, Betterment Cash Reserve was 4.50%, which included a temporary boost. So yeah, rates well above 4%, even pushing 5%. We're definitely still out there, mostly online.
What about CDs? Certificates of deposit, were they mentioned as an option too?
Briefly, yeah. CDs are different because you lock in a fixed rate for a specific term, 6 months, 1 year, 5 years, etc. The catch is you usually pay a penalty if you take the money out early.
Right, less flexible.
Less flexible. CD rates had also maybe dipped a bit from their peaks, but you could still potentially get a rate slightly higher than an HYSA if you were willing to lock up the money. Examples cited were like Marcus at 4.10% for a year, Bread Savings 4.35% for 6 months, Alliant and Discover both around 4.00% for a year. Worth comparing if you know you won't need the cash.
And money market accounts.
Similar to savings, often tiered rates may become with check rating ability. Discover's MMA was mentioned at 3.50% APY, so options exist.
Okay, but let's address the elephant in the room. Inflation is still around. Some people might think, why bother saving cash if it's losing purchasing power? What's the counter argument?
It's a totally fair question, and the sources tackled it directly. The primary reason for holding cash savings, especially right now, isn't necessarily about getting rich off the interest, though maximizing that is smart. It's about the safety net, the emergency fund.
Right.
Having that cushion, ideally 3 to 6 months of essential living costs in a safe, easily accessible place is critical. Why? Because life happens. Job loss, medical bills, car breaks down. When borrowing costs are high, like they are now, having that cash means you don't have to rack up expensive credit card debt or take out a high-interest loan just to cover an emergency. That fund protects you. Even saving small amounts, $10 a week, adds up to over $500 a year. Earning decent interest on it with an HYSA is a bonus that makes it grow faster.
So, emergency fund first, then worry about inflation beating returns later.
Pretty much. Get that emergency fund fully funded. Then, for money beyond that, you can think more strategically about CDs or maybe even longer-term investments if your goals align.
Makes sense. And there was a brief mention connecting high rates to those bank failures last year. SVB, Signature Bank.
Yeah, just a quick connection. Basically, the rapid rise in interest rates hurt the value of older, lower-yielding bonds that some banks were holding.
Okay.
If those banks suddenly needed cash, maybe because depositors were pulling money out and had to sell those bonds at a loss, that created big problems. For banks like SVB, which also had a lot of deposits above the insurance limit, it led to a loss of confidence, a bank run, and ultimately failure.
But the takeaway for most people is FDIC insurance.
Exactly. Reassurance that deposits are insured up to $250,000 per depositor per ownership category at each insured bank. And you can structure accounts to insure even larger amounts if needed.
Right. Okay, so we've gone through the Fed's role, the pause, how it hits mortgages, loans, savings. Let's bring it back to where we started, that June 7th jobs report. What does it really signal for where rates might go next?
Yeah, that report is the big piece of fresh data shaping the outlook right now. Because, like we said, the Fed is watching the labor market super closely.
And it came in hot.
Hotter than expected, yeah. 139,000 jobs added in May. The forecast was more like 125,000. So a clear sign of continued strength.
And that expert quote was pretty dramatic, nail in the coffin for summer cuts.
Very much so. The expert, Nigel Green, basically said the Fed needs to see the job market weaken before they'll cut rates. In this report, it's the opposite of weakness. It shows strength with staying power. His conclusion, summer cuts are off the table, period.
How did the markets react when that news hit?
It was interesting. Stock futures ticked up a bit at first, maybe seeing jobs as economic strength. But the bond market, yields jumped up pretty sharply, meaning bond traders immediately dialed back their expectations for rate cuts happening soon. Higher yields reflect the market pricing in the idea that the Fed's benchmark rate will stay higher for longer than previously thought. And then there's another wrinkle the sources brought up, adding to the uncertainty. Tariffs.
Trade policy. How does that fit in?
Well, the new tariffs being implemented are seen as potentially inflationary. The sources said they're poised to accelerate inflationary pressure.
Because imported goods get more expensive.
Exactly. Tariffs are taxes on imports. Those costs often get passed through to businesses and then to consumers via higher prices. Even if it takes a little while to show up fully in the official inflation numbers like CPI or PCE, the expectation is already there in the market, another potential source of upward price pressure.
Okay, so you've got a strong job market potentially pushing wages up.
Yep.
And now tariffs potentially pushing the cost of goods up.
Right.
That doesn't sound like a recipe for inflation just fading away quietly.
No, it suggests inflation might be sticky. These are headwinds making it harder for inflation to get back down to the Fed's target quickly. And the expert consensus seems to be, with jobs solid and now tariffs adding pressure, the Fed just has no justification to cut rates prematurely.
So the timeline for cuts gets pushed back.
That's the clear message. The forecast now is shifting. Forget summer. We're likely looking at September at the earliest, maybe even later, before the Fed feels comfortable enough to start cutting.
What happens if rates stay higher for longer than people were expecting? What are the potential impacts?
Well, the sources flagged a few things. Assets that are really sensitive to interest rates, think tech stocks, high-growth companies, maybe some emerging markets, they might feel the pressure. A lot of their valuations were based partly on expectations of lower rates coming sooner. And there are ongoing worries about sectors carrying a lot of debt, what the sources called over-leveraged sectors. Commercial real estate is often mentioned, certain types of consumer debt, maybe some regional banks that are more exposed, higher borrowing costs for longer make things tougher for them.
So the big policy shift, the pivot to cuts, it's still on hold.
Definitely on hold. The pivot right now, according to the experts, isn't towards cutting, it's a pivot towards more patience. The Fed is doubling down on the watch and wait approach, reinforced by this latest data. Getting inflation fully beat remains priority one.
Wow, okay. That was a lot to cover. Let's try and boil it down. What are the absolute key takeaways for someone listening, trying to make sense of all of this for their own situation?
I think the main thread is this. The Fed hit pause on its benchmark rate earlier this year after cutting late last year. That pause is continuing, mainly because inflation isn't fully cooperating and the job market looks surprisingly strong. This Fed rate influences everything, but in different ways. It affects the bond yields that fixed mortgages follow. It more directly impacts ARMs, personal loan rates, especially new ones, and very directly affects what you earn on savings.
And that June jobs report kind of threw cold water on hopes for quick relief.
Yeah, it really did. That strong report, plus these new worries about tariffs potentially boosting inflation, it makes summer rate cuts look extremely unlikely now. Expectations have shifted. September, maybe later, is the new time frame people are looking at.
So if you had to give our listener one core insight from digging through all this material, what would it be?
I think the biggest takeaway is that while we all watch the Fed's big moves, what matters most for you is understanding how those national decisions actually connect down to your specific mortgage, your loan, your savings account.
The personal connection.
Exactly. And because the path forward for rates is still pretty uncertain with strong jobs battling inflation and now tariffs in the mix, the things you can actively control become even more critical.
Like what specifically?
Like comparison shopping. Being relentless about finding the best rate you can get, whether you're borrowing or saving, because lender offers vary widely, like truly understanding the terms of any loan you have, especially if it's variable, and like focusing on your own financial foundation, building that emergency fund, managing your credit score well, making decisions based on your own needs and risk tolerance, not just trying to perfectly time the Fed's next move. It's about informed action in your circumstances. That's key in this kind of environment.
Informed action based on understanding the connections. That's a great takeaway. So as we wrap up, here's a final thought to chew on. Given this weird mix, a strong job market, keeping things humming, but inflation being stubborn, and now tariffs potentially throwing another wrench in the works, how does this complicated, unpredictable picture affect how you think about your finances, not just for the next few months, but longer term? How do you build financial resilience when the interest rate roadmap seems so foggy? Thanks for joining us for this deep dive on U.S. interest rates. We really hope sorting through the latest data and expert takes helps you navigate your own financial decisions.